Welcome. In DataBreak today, we're going to talk about a topic that seems to be news headlines on everybody's mind. It's the debt. And I'd like to bring your attention to the U.S. Debt Clock webpage. Just take a look for a moment. As it shows the U.S. national debt, I know it's mind-boggling, $31.7 trillion. They actually are rounding up. It's actually, to be specific, 31.4 trillion, but it's just absolutely flabbergasting, particularly when you consider that the gross domestic product, the GDP of the United States, is about 26.3 trillion. So we're falling behind. Well, let's take a look at what's going on and why. This is a web page from Fred, the St. Louis Federal Reserve Bank's research department, and it shows total federal public debt, $31.4 trillion. And it is, it is staggering. There's no question about that. So you begin to wonder, how did we get here? What created this? Why do we have this problem? It's interesting, there's a web page on the Treasury site that talks about understanding the national deficit and what happens. It's just like in personal finance. When you spend more money than you make, you end up in debt. And that's what's happened to this country, unfortunately. In the last 50 years, the federal government budget has run a surplus. That means they brought in more than they spent only 5 times. And most recently was in 2001. So to pay for government programs while operating under a deficit, the federal government borrows money by selling U.S. Treasury bonds and other securities, and this becomes the accumulated federal debt, the public debt that we're looking at. Well, this is just a little insight on the numbers of the debt and showing you the deficit. So the federal government spent 28.7% more than it collected in the last fiscal year, which resulted in a $1.45 trillion deficit. It's just compounding what's been going on. But it's worse over the last few years. When we look at the total public debt, if we drill down a little bit, let me just turn this into 5 years so you can see it, 10 years, so you can see a little closer what's going on. Interestingly enough, in 2008, it was about $9.4 trillion. In 2010, that was the end of the recession, as we call it, it was $14 trillion. So there was a $4.5 trillion increase in U.S. public debt over that period. That's the gray bars on the chart. The gray bars are recessions in the Fred charts. What's really concerning, though, as we look at what has gone on since then, from 2020 to 2022, in that time period, the federal U.S. public debt went from 23.2 trillion to where it is today, 31.4, or about $8.2 trillion. So it's doubled the highest last big growth spurt in public debt. Well, let's talk about how it's kind of broken out. The public debt, interestingly enough, and this gives us 2013 versus 2023, actually is a combination of money that's owed to the public, or that's international as well as local in the country, and the Fed, of course, and what's owed intergovernmental. So you can see that the 31.4 trillion is a combination of 24.6, that's government securities, if you will, and about almost 7 trillion that's owed to the other intergovernmental entities. So about almost 80% of the public debt is actually held by the public, if you will. Let's look for a moment about the current, last year's budget. This is federal budget for 2022. And it's interesting, we can actually highlight here the interest expense. So interest on the debt, that $24.5 trillion, was $483.5 billion. It amounts to something in the range of a little less than 2%. So that's one of our points, key points, is that the largest loser with higher interest rates is us. The U.S. government has to pay higher costs. And in fact, If we think about where things are going in the future, in 2023, this interest on the public debt is forecast to be $640 billion. And by 2024, it's going to be $740 billion. So by next year, the interest on the public debt at current rates is going to be $740 billion. Let's look for a moment at who holds the that $24.5 trillion of public debt the government has issued. This is a chart from Fred that shows what's held by the Fed and Federal Reserve banks. It's interesting if we, let's just zoom in a little bit here for what's happened in the last, let's take the last year. It makes it very clear what's going on. At the peak, the Fed had about $6.25 trillion of U.S. Treasuries and bonds. But you can see what's happened over the last year. They've declined by several $100 billion. So they've been not renewing things that have matured. Unfortunately, this is the exact same situation for federal debt held by others. This is the other countries that have large federal debt holdings. Let's see, let's do the same thing. Let's take the 1 year and you can see what happened. You know, it was $7.7 trillion back a year ago, and now it's kind of bottomed out and has gone to 7.3 trillion. So there's another 400 trillion that other international investors have not renewed or bought, which has reduced the demand for U.S. Treasuries. The top holders, of course, Japan is number one. They've reduced their current holdings, but they're now still north of $1 trillion. China, who used to have about almost $1.5 trillion, is now down to about 890 billion. And the other big three are the United Kingdom, Belgium, and Luxembourg. Let's look for a moment at, kind of what does this mean to us when we think about it? Well, interestingly enough, there's a high correlation between the 10-year U.S. Treasury and real estate analytics. So let's look for a moment. This is the, again, a Fed chart going back to 1960, which shows us the 10-year U.S. Treasury yield. And we can see there was, back in the recessionary period, that the 79 to 80 interest rates got extraordinarily high. But let's look at the last 10 years as an example. The last 10 years is a little more of a normal thing. In fact, over the last 20 years, the 10-year Treasury rate has averaged just about 2.9%. So you can see what we're just experiencing today is a little unusual, as the case may be, based on long-term items. And so again, we say, why do we care about this? Well, let me share with you the chart, which is one that Jim Costello put together. In fact, let me show you, I mentioned the average rates and so forth. Let me show you the 10-year U.S. Treasury rate from the Urban Land Institute Research Department, where they're showing that the 20-year average is 2.9%. And frankly, I like the way that sounds. 2.9% is good. Why do we care? Well, look at the slide that we're showing you now. It's some work that Jim Costello from Real Capital Analytics did called Decomposition of U.S. Commercial Cap Rates. It's a three-layer element. The first layer is typically called the cost of funds, but the proxy for cost of funds in commercial real estate is the 10-year U.S. Treasury. And then, of course, the lender expects to make a little bit of a profit, so they have a debt spread. And then you've got the owner who has the equity spread. So those three layers put together gives us the rate of return required for commercial real estate. And this is how we calculate pricing and value. So when you could keep this in mind, it becomes very apparent why interest rates are so important to our industry, a big influence on commercial real estate. The higher the 10-year Treasury goes, that means that cap rates have to go higher. Well, they don't go higher automatically all at once. Typically, it's an incremental thing. And so for a while, the lenders operate with a slightly lower spread. And of course, the equity, the owners get squeezed more than anybody else. And then it begins to normalize. And that's what we expect to see going on into 2024 and 2025. A little more normalization of the returns that are shown on the decomposition of U.S. cap rates. So I don't want to sound unduly depressing with you. So I want to end with a really great chart that shows population growth in Florida and some of the key counties in Florida that we concentrate our commercial activities in. Why is that important? Well, real estate is space for people. More people means increased demand for real estate. And so although the rest of the country may suffer with some sort of recessionary trends, headwinds, and so forth, in Florida, we're going to be very insulated because of the population growth. As you notice on the chart, it shows that the population in Florida now is growing by 1,142 people a day. That's the latest U.S. Census estimates. Just absolutely flabbergasting. We're the, of course, third largest state behind California and Texas. And Texas is growing, of course, by more people than Florida, ever slightly, but they're a 30 million base. So our percentage of growth is the top in the country. And then when we look at some of the key markets, our commercial focus, which is Polk County, Hillsborough County, Orange County, Osceola County, and Lake County, those are some of the fastest growing counties in Florida. In fact, our market area, these 5 counties, accounts for about 20% of the population of Florida. It's about 4.5 million people, and it's almost 30% of the growth. So I'd like to end with a bit of good news. It's good to be in Florida. It's even better to be in Central Florida. Thank you.